Welcome to your monthly market report for September of 2022. My name is Kate Rezebeck, and today David Childers and I are going to walk you through three of the most important topics happening right now in the housing market. We're going to be going over mortgage rate projections from the experts. We're going to talk about home prices, and we're going to wrap up on affordability, something that's definitely top of mind for almost everyone right now. So I'm going to begin today with mortgage rate projections from the experts. And I think we can all probably agree that this year in the housing market has truly been defined by rising mortgage rates. This is a look at the Freddie Mac 30-year fixed rate going all the way back to January of 2022. And if you follow along with us, you've definitely seen this before. But what it shows is how much mortgage rates really rose from the beginning of the year all the way into mid to late June-ish. And then since then, you can see that there's been a lot of volatility or fluctuation in mortgage rates over the past few months. So why is that? Well, you've heard us say that inflation is the enemy of long-term interest rates, and that's certainly something that we are following right now. We know that the Federal Reserve doesn't call mortgage rates, but they're certainly making moves right now to ease inflation. And, when that happens, mortgage rates tend to respond. So we're watching all of the different economic factors that impact mortgage rates and how that's, playing out over time. It's certainly something we're keeping our eyes on. And, one thing that we can do in the meantime is we can turn to the experts to say, what are the projections for going forward? Everyone wants to know, where are mortgage rates headed? Well, if we look at these projections from Freddie Mac, Fannie Mae, MBA, and NAR, these are the latest data we have as of August of this year. And if we average all of their projections together over the next 4 quarters, what we can see over in that right-hand column is that mortgage rates are projected to essentially stabilize over the next year. So, really looking at this, trying to figure out, what's going to happen with mortgage rates, this is a great place to look for information and may be a nod to the experts feeling that, the Federal Reserve is going to get inflation under control. If that's the case, then, mortgage rates, we do hope stabilize at this point. That's certainly what we're looking forward to, and hope that the experts are correct in these projections as we continue to watch all of the economic drivers around us. And, I think as we look at this, low to mid fives is the projection, maybe even by next year at this time, dipping into the high 4% range. That could bring a lot of predictability for buyers. And I think that this next quote really kind of says that well. This is from Lisa Sturdivant, a housing market economist that we follow. And she says, after the end of summer lull and as mortgage rates stabilize, we may see a return of buyers and a relatively strong fall housing market. So that could be great news. If mortgage rates do stabilize, we may see more buyers coming back into the market. We certainly know that rising mortgage rates have caused many buyers to step out of the home buying or selling process. But with these projections at hand, should they play out, we could see stabilization in that and a very strong fall housing market. Certainly something we are keeping our eyes on, and we are watching to see what the experts say as well. So another topic that's on everyone's mind is home price appreciation. And we actually surveyed about 400 agents over the past month. And we asked these agents, what is the number one question that your buyers and sellers are asking you right now? And one of the top ones that definitely rose to the top of the list was, what's happening with home prices? Where are home prices headed? So what I'm going to do today is break down today's home price appreciation, because this is a really complicated topic, and I'm going to do my best to explain it. Because what we're hearing right now is home prices are appreciating, but we're talking about deceleration. And then we're seeing in some markets, sellers bringing their list prices down. There's a lot of confusing information out there, and I want to do my best to share this with you. So what we're going to start with is this quote from Mark Zandi, chief economist at Moody's Analytics. And he says, I don't think national housing prices will decline in a meaningful way, but there will be some price declines across the country. So what does that mean? Well, on average, nationally, we project that home prices will continue to rise. We're seeing that in expert projections. But at the same time, we also know that there are some overheated markets throughout the country, especially out on the West Coast, where there will likely be price declines. And you're probably seeing this in some of your markets right now. And so, what I want to do today is bring context to this to show how home price appreciation is still expected going forward based on today's buyer demand and low inventory. But what does that mean in the grand scheme of things? And I think this chart, this graph, that you've seen us use before really helps to articulate this. This is that appreciation is slowing, not depreciating. And that's where deceleration comes into play. So let me walk you through this. This is the percent year over year home price increases for 2022 so far. And this is data from CoreLogic. Latest data was just released. And so what you can see here is that year over year, January, February, March, home prices were still accelerating at a pretty rapid pace, record-breaking home price appreciation at the beginning of this year. But what has happened since then? We've come off that high of 20% year-over-year home price appreciation, and it's starting to cool. And that's what you can see May, June, July. That's the deceleration in prices. So what this means is year over year, July, let's say July of this year compared to July of last year, home prices were still 15.8% higher on the national average compared to last year. But that's a slower pace than that high of over 20% that we saw at the beginning of the year, end of last year. So the pace of appreciation is slowing. That's deceleration. It's not depreciation, where we would have negative price growth. But here's where it gets confusing, because in some markets, we're also seeing that, homeowners are dropping their list price, for example. So let's say you had a client whose home could have sold for $400,000 3-4 months ago. Well, now that home would only sell for $370,000. In that case, it feels like depreciation. And that's because home prices are measured in a couple of different ways. So year over year, what you're seeing here is continued appreciation at a slower pace. But month over month, we are certainly keeping our eye on that because that's what your clients are looking at. That's what they're feeling if they're thinking prices are going down. And so, we're going to keep our eye on this home price appreciation. We still know that there are plenty of buyers out there. There is still low inventory. We know that prices are, projected to continue rising, but at a slower pace. So we're going to keep our eyes on all of this. And truthfully, what this means is that, a year ago, the listing price was the floor of the negotiation. You could list a home, you could maybe list a little higher than what you thought it was worth. And then, buyers would still come in, multiple offers, bidding wars, bid the price up for a home. That was the floor of the negotiation. What's happening now as the market starts to shift is that the listing price is probably more of the ceiling of the negotiation. Buyers have a little bit more negotiating power. We're seeing changes month over month, and that's what we're keeping our eyes on. So home price appreciation is slowing, not depreciating on an annual basis. And I think this quote from CoreLogic really helps to articulate that. It says, annual home price growth slowed for the third consecutive month in July, but remained elevated at 15.8%. That's the graph that we just showed you. As 30-year fixed rate mortgages neared 6% this summer, some prospective home buyers pulled back, helping ease overheated and unsustainable price growth. We know the past 2 years have been an anomaly. The price growth over the past year in particular was unsustainable price growth. Looking ahead, CoreLogic expects to see a more balanced housing market with year-over-year appreciation slowing to 3.8% by July of 2023. So by July of next year, CoreLogic is projecting that homes will still be appreciating in value, but at a much slower pace. That's that deceleration continuing. And this is much more in line with what we're seeing from the Home Price Expectation Survey and what they are saying for continued price growth. Higher this year and a little bit more towards a normal range next year and beyond. Leading up to the pandemic, the average or typical home price appreciation over a typical year was about 3.8%. So that's what experts are starting to see as they look forward. However, what I also want to walk you through is many experts raised their home price forecast this year. So this is very typical. And what you can see here, these are January forecasts for 2022 home price appreciation. That's what you see in the middle column compared to the latest forecast. And those are in the right-hand column. So what usually happens as you start a calendar year is the experts project out, what do we think home price appreciation is going to be this year? They're looking at buyer demand, they're looking at supply, inventory, all of the different things that drive home price growth. And they project out for the year. Well, as the year goes by, experts tend to reforecast based on what's actually happening in the market. And so that's what you can see here is that this year, experts, even though prices were decelerating, reprojected a higher home price appreciation for the 2022 calendar year. And that's what you see here. So, we're hearing all these different terms. We're seeing these home price forecasts. Trying to make sense of it all is very confusing. But what experts really saw at the beginning of the year was that, they thought we were going to see more inventory coming into the market. Mortgage rates hadn't risen as much as they had to soften buyer demand. And so as the year progressed and they realized, inventory is still pretty low, buyer demand is softening, what's going to happen here? They reforecast up. And that's what the green column is showing you from each of those experts. So what does this look like for 2022? We bring this graph to you often to show you the latest home price projections for the year. And the average of all 7 forecasts that we follow is showing 11.3% annual appreciation for 2022. Now, what we have to remember is that the majority of that home price appreciation happened earlier this year. It happened at the beginning of the year. And we're seeing that softening, but experts still projecting by the end of the year, 11.3% home price appreciation for 2022. So why is that? Well, that's because inventory is still historically low. And if we look at this data from calculated risk, this kind of helps us compare where we are today versus where we were over the past few years. So if you look at that blue bar on the left, you can see that inventory is 26.3% higher than it was the week ending September 2nd of last year. So year over year comparison for the last week of August and into the first couple days of September, 26.3% more inventory. So that is, creating more opportunities for buyers. It has helped with the softening of home prices for sure. But compared to the same week in 2020, inventory is still down 5.4%. And compared to 2019, prior to the pandemic, inventory is still historically low, down 42.2% from where we were that same week in 2019. So that's what's continuing to drive upward pressure on home prices. Inventory is still low. We still have buyers in the market. Yes, we've seen a softening, a cooling, a slowing, but home prices are projected to continue rising, primarily based on this inventory data as well. So really, really important to be able to get this information out to your buyers, to your sellers, so they understand where are mortgage rates projected to go, what's happening with home prices, working with you as a trusted expert in this process to make sure that they have the data and the facts on what's happening today. And of course, anytime we're talking about mortgage rates and prices, we know that that impacts affordability as well. So I'm going to turn it over to David to walk you through the latest on home affordability.
So thanks, Kate. Let's talk just a minute about affordability. This is a topic I think that comes up in a lot of cases, mainly right now in the media, people saying, are homes even affordable right now? And I want to break down affordability from a couple of different angles in reports and things that we use so many times on the monthly market report and give you a look at that. But more importantly, help you communicate this to the clients that you're working with. So if we start here, let's start with the first place, the Housing Affordability Index that NAR releases. They release that every month. This is a look, if you're familiar with the monthly market report and you followed this and listened, you've seen it before. Housing affordability right now is lower than it's been going all the way back to the early 90s. This is a look at the going back to 1990. and housing affordability, the way you read this is the higher the bar is, the more affordable a home is. And right now you see the red bar below the years that we show here going all the way back to the 90s. And what stands out are the years after the housing crisis where, distressed properties dominated the market. The high of that market, the housing affordability index, we're at 197. Right now we're at 98.5. The way you read this is 100 reading of the housing affordability index is really a kind of an even reading. That means the average individual, the average household in this country can afford 100% of the average mortgage payment. So it's even, right? You make enough money to afford an average home, and that is even affordability. And we've gotten a lot of cover from interest rates over the last several years and seen great affordability. And right now, the average household can afford 98.5% of the average mortgage payment. So less affordable, you could maybe even say unaffordable. You may see that some places, and that's where that comes from, but certainly not an apocalyptic scenario by any means in housing affordability. Now, that's based upon three things. It's based on prices of homes, it's based on interest rates, and it's based on wages. That's how they come up with the housing affordability index. So based on where this is heading in the future, what do you believe about prices, interest rates, and wages in this country? That'll help you give expert advice in this affordability category, because a lot of people are asking those questions. If we continue on this, NAR came out with this very interesting point about mortgage payments. Compared to 1 year ago, the monthly mortgage payment rose to $1,944 from $1,265. That's an increase of 53.7%. So, homes less affordable right now, and mortgage payments have been increasing. If you look at this graphically, this is what this looks like going all the way back to the last reading of June. This is the most recent information that we have in the statement that I just gave you from NAR. No doubt, as people have gone through the pandemic, the meaning of home changed, and they've said, you know what, we're willing to pay for what we want. And we're seeing that right now in rising mortgage payments across the country. Another thing that we want to look at when we start to break down affordability and understand that is we want to look at what is the average mortgage payment or income committed to a mortgage payment. And right now that sits at 25.4%. That assumes a 30-year fixed mortgage rate with a 20% down payment on a median priced home with median income. So, go back to the kind of the affordability equation. The median income, the median price home, somebody is dedicating 25.4% of their income to a housing payment. Why is that important? Well, if you look at this, 25% is typically what is recommended. We're slightly above that. Again, I'm going to go back to not an apocalyptic scenario, but above that. And so if you hear that word, affordability, coming out, you can give context to that and what that means. As you think about housing, one of the greatest benefits of buying a home versus renting is you benefit from a refinance as rates dip in certain times. And I'm certainly not suggesting that somebody should buy a home based on just the opportunity to refinance, but it is something that we want to remind people of, that you can buy now, and as prices rise, which is certainly what is projected, and if there is an opportunity to refinance, you can do that down the road, and that is very, very important for those that own homes. This is all about incomes and qualifying incomes, and looking at what people are making, what the price of the home is, and certainly what the interest rate is, and that helps us break that down. If we further break this down, if you look at median household income versus qualifying income, here's what becomes very, very clear is this is not the same across the country. If you go look to the West, the qualifying income, what you need to make to buy a home is, in the West, certainly significantly higher than what the median income is. So how do you read this? In the West, homes are less affordable. In the South, they're sort of neck and neck. In the Midwest, median income is higher than the qualifying income. So bringing in your local information and what you're seeing happening in your market is critical in this conversation. But being able to be educated, being able to bring the truth about affordability to folks is what we have to do. And if you look at this graphic here in the U.S., sort of neck and neck, the median income in this country, $1,952 versus a qualifying income needed $93,312. So certainly seeing the rise in interest rates lessen the buying power of consumers relative to housing across the country. So we want to stay on top of that. Our research team is saying on top of that so that you have the best information on affordability out there. So what can you do in a scenario like this? I want to sort of wrap up with a couple of things and give you a couple of resources and what you can do. Three things I think you can do right now or coach people that maybe are struggling with affordability. First, you can expand your search area and criteria. You know, somebody that maybe was looking at buying a home near the city center or in the town maybe need to look a little bit further out or look to where things might be more affordable than in the area that was their first choice. So that's one thing you can do. Second thing you can do is help someone explore alternative financing options. You know, if you're an agent today that doesn't have a great lender partner, I'm going to encourage you to find a great lender partner in your market that can help folks understand this is what you qualify for. This is the products that are available in the market. This is how you can manage that debt based on what we've seen in rising prices and rising interest rates. I think it's critically important to explore those alternative financing options. And this is no way telling people you should go out and buy something with the intent of refinancing, like we just said. Not at all, but understanding what's important to you and how do you structure that debt? What are the options out there that may help you do that more affordably? Third thing you can do, you can look for grants in your area, gift funds. You know, there are sources like downpaymentresource.com, great organization that you can go in there and say, what are the down payment resources? What are the resources that are available in my community for those that are looking to buy? And those are arranged by a number of different ways. But, you know, a lot of times you think about a first-time home buyer down payment credit or grant or something like that. But look for those options. Look for gift funds. Are there areas where people can use gift funds to get into a home and combat rising affordability? So I think there are things we can do, and we can give great advice in this, understanding this topic and being fluent in it. I'll wrap up with this. Allie Wolf from Zonda said this. I think it's critically important, you know, with what Kate said, what we're talking about here with affordability. We're in a place where strategy discussions and planning are critically important to make sure we can thrive during these challenging times. Stay nimble, stay informed, and remember, housing is traditionally one of the first sectors to slow as the economy shifts, but is also one of the first to rebound. You know, we've done a lot of work on recession, and that topic continues to come up as we see the economy slowing, but staying nimble, staying informed, like we do here at the Monthly Market Report, is key. So, how do you best educate the clients that you serve right now? I'm gonna offer this. They just came out. Our fall buyer and seller guides are now available. You know, you can print those, you can use them in an electronic format. You can get those in the hands of those that are, you know, maybe saying, hey, we're thinking about putting our home on the market, or, you know, we're thinking about buying now that we've seen, more inventory come about on the market. What about all those people that over the last couple of years that gave up their search for a new home because they felt like it was impossible? They said, you know what, we lost out on bidding wars, we lost out in a number of different ways. Being able to educate them and deliver to them, this is what's happening in the market, is what our job is. And buyer and seller guides do that. You can put them in the hands of those you're working with. You can use them at open houses. You can use them in a lot of different areas. So go check those out. Go download those and grab those today. As always, as I wrap up here, thank you to Kate that kicked off today and brought a great bit of information. And, more than anything, thank you for investing the time that you do and listening each month to the Monthly Market Report. You know, our goal is to give you what you need to know to be the most educated professional in your market. And that's our aim. So we'll see you back next month. And thanks for joining us this month.